The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Now, Trump's latest tariffs on UK exports have reignited tensions in the global spirits trade, this time hitting Scotch whisky with a 10% blow. It's a move that threatens to disrupt a 1.6 billion Sing dollar export market and puts added strain on distillers already navigating economic headwinds. From the potential impact on small producers and whiskey tourism to shifting consumer loyalties and investor uncertainty, the implications go far beyond just price tags. So to find out what this all means for whiskey producers, investors, and the future of the industry, we're joined now by Samuel Gordon, who is the CEO of GORDON PWC. Hi, Samuel. Thank you so much for joining me once again.
Pleasure to be back, Hongbin.
All right, Samuel. Trump's 10% tariff on Scotch whisky exports from the UK to the US has created challenges for that market. How significant is this for the Scotch whisky industry, and how does it compare to the tequila market, where no tariffs have been imposed on exports from Mexico to the US?
Significant for the Scotch whisky industry. The industry has such a heavy reliance on the US for its sales every year. It currently accounts for about a seventh of the market sales. We saw back in 2019, during Trump's first term, he imposed a 25% tariff, which from my understanding was purely on single malt exports. And this knocked around 700 million in sales over a single 12-month term. So yes, the tariff this time is only 10%. However, you could still expect the impact to be significant for demand side of the Scotch whisky industry. For tequila, the story is quite different. Trump has not imposed any tariffs on Mexican exports to the US, thanks to our pre-existing trade agreements between the US and Mexico. Again, the US is a key market for tequila. It accounts for about 70 to 75% of sales each year. So the fact that no tariffs have been imposed would also suggest that on the demand side and that continued growth in the US, it's a very strong indicator for the tequila market versus the Scotch market.
Well, given the tariff situation with Scotch whisky, do you think that premium spirits markets, including tequila and whiskey, are more vulnerable to trade barriers or price fluctuations? How resilient are these markets to potential tariffs or trade shifts in the future?
Look, I think when we talk about the vulnerability of both markets, we can talk about it differently. With Scotch and tequila, with tequila, the industry itself, unlike Scotch, the US cannot offer a direct alternative for US consumers, which means that there's little to no economic benefit for the US to impose tariffs on Mexico or specifically tequila and push up prices for consumers in the US. This is different with Scotch. America has a booming bourbon industry, rye whiskey industry, even now a single malt industry, which is thriving as well, which certainly makes the Scotch market more vulnerable to these trade barriers and potential price fluctuations, which isn't the case with tequila, as explained. In terms of their resilience, Scotch certainly has in its favour the fact that it's globalised so much over the last 20 or 30 years, and its reliance on the US isn't as heavy as tequila market's reliance on the US. Again, the Scotch market, it's about 15% of sales in the US every year. The tequila market is about 70 to 75% of sales every year. And the tequila market is a $16.5 billion a year industry. So it's significant, the reliance on the US. So from that perspective, the Scotch market does have more resilience. Both have in their favour, Hongbin, the fact that they're both very premium. So the premiumisation, the consumers that seek high-quality Scotch, single malt, aged Scotch, or 100% agave, high-quality tequila, aged tequila, these consumers typically do well in any economy, which means that on the demand side again, it does mean that that's well insulated should there be any further trade barriers, price fluctuations, etc.
Well, in both the tequila and whiskey sectors, there's been an increasing demand for premium products. So, Samuel, how do you see this trend evolving, and in what ways are these high-end markets with their loyal consumer base less impacted by potential price hikes or tariffs?
If we focus on the trend evolving side of things, I'd focus on tequila, really, because tequila is where whiskey was, let's say 20 or 30 years ago, back in the 80s and 90s. Prior to that, blended Scotch had dominated the market. Brands like Johnny Walker, Bell's, Cutty Sark, etc. During the 80s and 90s, the market began to premiumise. Consumers began to seek aged expressions, 12-year-old, 15-year-old, 18-year-olds. And that was the rise of single malt distilleries, some of the most well-known ones today, Macallan, Bowmore, Glenlivet, Glenfiddich, etc. We're now seeing the same trends over the last decades within the tequila category, where consumers are now seeking 100% agave tequila. So that is akin to a single malt Scotch, for example, the purest expression of the spirit. And they're also now seeking aged expressions such as extra añejo tequila, for example, which is 3-year-old tequila. In terms of the customer base, again, on the demand side, a very strong indicator because both markets are so premium. The consumers, they are, as I've mentioned previously, less impacted, they're less price sensitive, and they do well in any economy. So again, on the demand side, it's a very positive indicator for both markets.
Well, there are also fixed return products in both the tequila and whiskey markets where brands commit to buying back aged spirits at a set price on a set day. How does this model provide downside protection for investors, particularly in terms of market uncertainty or when tariffs might cause disruptions in pricing?
On the fixed return products in our portfolio, each premium brand that we work with, we have 3 products. We have free market products whether that's at year 3 with tequila or year 10 or 12 or 15 with Scotch, for example, the spirit will be resold to brands at the prevailing market rates. And that's a free market product. The fixed products are different. So we've got fixed return products where, for example, with tequila at year 3, they're going to be resold on a set day and at a set price to a brand. And that is pre-agreed when the investor enters the investment. And that's all backed by secure commercial contracts with these brands. There's also minimum return products as well, where there's essentially a stop loss. The brands are committing to buy back at a stop loss price. It's always going to be a few percentage points lower than the fixed return purely. But the investors also participate.
Right.
So they're the 3 products. They're all underwritten by secure commercial contracts again, and the underlying assets there are ultimately casks containing either tequila or whiskey. In terms of the downside protection, what investors typically do, Hongbin, is they construct a portfolio that comprises all 3 of those products. So it's a balance of higher risk, perhaps with the free market products, and reward.
Well, with the growing demand of premium spirits globally, then how important is diversification in both the whiskey and tequila markets, Samuel? I mean, in addition to the U.S., are there emerging markets that are becoming key to the growth of premium spirits? And how are brands positioning themselves to navigate any potential future trade disruptions?
Yeah, diversification always key, even within premium spirit markets. So within an investor's portfolio, they will have different objectives. Tequila and whiskey can meet very different objectives for different investors. For the same investor, tequila is a shorter-term investment, 3 years. Whiskey is a longer-term investment, 10-plus years. Investors with different risk profiles and different objectives from an ROI perspective. Tequila is an emerging market, an exciting market that could show potentially higher returns than the whiskey markets, but as the whiskey market is more established and offers more stable returns of somewhere between 8 and 12% per annum on average. In terms of emerging markets, again, the whiskey market is more established, it's more globalized, but there are still significant opportunities for growth in developing markets like South America's, China, India, etc. Tequila is in a very different place where the US holds the lion's share of the market, but it's the other key alcohol markets now, like the UK, like Canada. Spain is the fastest growing market in the world, Australia, Hong Kong, Singapore, etc. These are now all showing the highest growth rates for the tequila markets. So a huge growth opportunity there still. In terms of the brands positioning themselves for future trade disruptions, you've got to focus on that premium aspect and appealing to that consumer base that is less affected price fluctuations.
Well, how do you think the imposition of tariffs on Scotch whiskey will impact smaller distilleries compared to, larger brands? And what strategies can these smaller producers use to mitigate the financial strain?
I don't want to sound like a broken record here, but again, that focus on becoming premium and being able to appeal to that consumer base. Again, when prices are rising, inflation is rising, we're all expecting that now, certainly as a result of these trade tariffs. When wages are not rising as fast as prices are rising or inflation is increasing, these consumers that are attracted to these premium spirits that have higher prices, they are less affected. And again, on the demand side, that keeps demand strong. And in terms of these smaller producers, if they can appeal to that audience and build up their brand, it means that they're going to be less affected as well.
Well, given the historical context of a 25% tariff on Scotch whiskey between 2019 and 2021, Samuel, what lessons have distilleries learned and how are they better prepared to handle this new 10% tariff?
Yeah, again, it's a significantly lower tariff than what was imposed back in Trump's first term, which is positive again. If we're talking about Scotch specifically here, again, these emerging markets that have significant room for growth as the middle class is growing, for example, in India, in China, in the South Americas, the economy is getting stronger. That is going to enable, should these tariffs increase or should these tariffs persist in the US, there's going to be less and less of a reliance on the US markets and enable demand to still grow. I think one of the negatives about these markets is they're not, although the growth opportunity is significant, they're not necessarily consuming premium tequila. There is still a significantly higher demand for less premium whiskey. There's still there's still a higher demand for blended expressions, for example, so Johnny Walker, Cutty Sark, and so on.
Some great insights there, Samuel. Before we let you go here, with the global nature of the spirits market, how can Scotch whiskey producers work with other industry partners to address these tariff issues and maintain strong export relationships, especially with major markets like the U.S.? Yeah,
I think it's going to be extremely challenging. But again, you touch on the global nature of be that Scotch or be that tequila, and being able to grow the demand in other key alcohol markets or in developing nations is essential to keep demand strong. I think if we're talking about the tequila market, recent acquisitions from brands like Diageo, Bacardi, LVMH, Brown-Forman, etc., that have all acquired tequila brands, tequila distilleries, with the marketing power that they've got, has contributed significantly to the globalization of the tequila markets. And the same with the celebrity brands as well, especially the power of social media today, the reach that has. Everybody is focused on social media. The brands from the likes of Michael Jordan, Justin Timberlake, Kevin Hart, Kendall Jenner, and so on, has really contributed to the globalization. So that is key, again, on the demand side, is that globalization.
I see. Well, thank you so much, Samuel, for joining me today.
Pleasure, Hongbin.
Thank
you for having me.
That was Samuel Gordon, who is the CEO of GORDON PWC. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.